very good morning to all. As far as CA firms are concerned, we are nearing a busy season of income tax return filings. It is very important that we are aware and familiar of the recent changes in income tax provisions.
In this video presentation, we will deal with the changes relevant for assessment year 2018-19. We will try to cover the most important aspects. Some relevant points introduced in earlier assessment years have also been discussed here. One of the most discussed changes that happened in assessment year 2018-19 is the introduction of late fee under section 234F. This late fee is levied for delayed filing of income tax returns. That is, if return is filed after July 31st or September 30th as the case may be, thus late fee is leviable. The late fee will be rupees 5,000 in case the return is filed after the due date but before 31st December of the relevant assessment year. If the return is filed after 31st December of the relevant assessment year, the late fee will be rupees 10,000. A relaxation is given to taxpayers with total income less than rupees 5 lakhs. In that case, late fee will be only rupees 1,000. When should an individual assessee file income tax return? If the total income of the individual assessee before claiming exemptions, that is under 10, or deductions under Chapter 6A exceed the basic exemption limit, the individual assessee should mandatorily file income tax return. Even if the tax payable in that case is 0, he should file returns. For example, if the gross total income of an assessee is rupees 3,50,000 and he has ATC deductions of rupees 1,50,000, his total income is only rupees 2 lakhs and there is no tax payable, but still he has to file income tax return. In the case of a partnership or a company, income tax return is mandatory for every assessment year. Even if the company has no business operations, a return has to be filed. There is a very important amendment in the case of return filings for charitable institutions and cooperative societies. In the case of charitable institutions with 12-year registration, no exemptions will be granted if the return is filed after the time limit under section 139(1). Similarly, in the case of cooperative societies, most deductions under Chapter 6A, like that of section 80P, will not be allowed if the return is filed after the time limit under section 139(1). ITR 1 is a simple one-page return that can be used by individual assessees. The change this year is ITR 1 can be used only by resident taxpayers. Non-resident taxpayers will have to use ITR 2 or other forms. There is a change, the time limit for filing revised return under section 139(5). For assessment year 2017-18, the time limit was 1 year from the end of the relevant assessment year. That is, revised return for assessment year 2017-18 can be filed until 31st March 2019. But from assessment year 2018-19, the time limit for revised return has been reduced. The new time limit is only until the end of the relevant assessment year. That is, revised return for assessment year 2018-19 can be filed only until 31st March 2019. From assessment year 2017-18, even belated return can be revised. When filing income tax return for a non-resident, make sure that the assessee is indeed a non-resident. This can be done by counting the number of days the assessee was present in India. Many occasions, assessees declare themselves as non-resident, but when we check the passport data, we see that the assessee is a resident. All Indian income is taxable in the case of a non-resident. Example, capital gains on immobile property in India, interest income other than NRE bank interest, house property income, etc. are taxable in India. From this year, that is assessment year 2018-19, the non-resident may mention foreign bank account for receiving the refund. After the introduction of Black Money Act, disclosure of foreign assets in the return has become very relevant. So the next question is, who has to make foreign asset disclosure? In the case of a resident and ordinary resident, foreign asset disclosure is mandatory. Also in the case of trust outside India, where trustee, settlor or beneficiary is a resident and ordinary resident, foreign asset disclosure is required. What assets has to be disclosed? Foreign bank accounts, immobile property, financial interest, capital assets, trust, and accounts in which individual as signing authority has to be disclosed. As already said, the consequence of non-disclosure is huge. Non-disclosed assets can be taxed under Black Money Act. A flat rate of 30% is applicable. Also, a penalty can be levied up to 300% of the tax. Additional penalty for non-disclosure is up to rupees 10 lakhs. ITR 4 can be used for filing presumptive income of business or profession. The case of business under 44 AD, a minimum of 8% of gross turnover will be deemed as income. But if the payments are received through account payee checks, drafts or electronic bank clearing system, the 8% has been reduced to 6% of gross turnover. There are some additional disclosure requirements in ITR 4. They are GST registration number, turnover reported in GST returns. The following are mandatory fields: creditors, debtors, stock in trade, and cash balance. A few non-mandatory fields are also introduced this year. They are partners or members' capital, secured loan, unsecured loan, advances, and fixed assets. A few changes have been brought in section 80D over the last couple of years. I would like to remind a few provisions in 80D. A deduction of rupees 5,000 up to 5,000 is available for amount spent for health checkup. One important point is the deduction for health checkup is available even if it is paid in cash. This deduction can be availed by assessee's family as well as assessee's parents. There is no change in the overall limit. That is, deduction for health checkup will be included in the overall limit of 25,000 or 30,000 as the case may be. Additionally, in respect of super senior citizens, that is assessees above the age of 80 years, without medical insurance coverage, a deduction of up to 30,000 is available for medical expense paid. Thus, 30,000 is available only if it is paid otherwise than by cash. There is an important amendment in the income tax depreciation rates. the income tax depreciation rate has been now capped to 40% for any class of assets. Assets which enjoyed depreciation above 40% earlier, for example, depreciation for computers was 60%, that will be restricted to 40% from now on. Dividend income is usually considered as a tax-free income. Dividend income which suffered dividend distribution tax is exempt under section 1034 in the hands of shareholder. However, if dividend income is received by individual, HUF or a firm and it exceeds rupees 10 lakhs, then a 10% tax is payable on the amount in excess of rupees 10 lakhs. For example, if dividend income is 14 lakhs, 10% tax is payable on rupees 4 lakhs. A few additional disclosure requirements are introduced for reporting salary income and house property income. These are applicable for ITR 1 to ITR 4. Earlier, only the tax amount was required to be disclosed. Now, in the case of salary income, detailed computation has to be given, usually the ones provided in Form 16. In the case of house property income, details of arriving at gross annual value, deductions and net annual value will have to be shown. There is a very important change in the computation of capital gains on transfer of unquoted shares. The sale consideration for transfer will be the higher of either transaction value or the fair market value calculated as per valuation report provided by a merchant banker or a chartered accountant. With effect from 24th May 2018, a chartered accountant cannot issue a valuation report. But in any case, a valuation report is mandatory. ITR 6 is the income tax return form for companies. A company needs to disclose GST related particulars like transactions in exempt goods or services, transactions with composite suppliers, transactions with registered entities, total sum paid to them, and transactions with unregistered entities. Ensure that GST returns filed matches with the details provided in the income tax return. The new ITR 6 requires every unlisted company to provide details of all beneficial owners for holding 10% or more of the voting power directly or indirectly at any time during the year. In such a case, provide the name, address, percentage of shares held and PAN of beneficial owners. There are several situations where TDS in respect of income of a person is deducted under the PAN of a different person. For example, deposits held in joint name and TDS deducted only in the first account holder's name, or partners TDS deducted in firm's PAN, or inheritance. There are many such cases. Now, TDS credits may be transferred by the deductee and the same can be claimed by another person in his return. There is a very important change in the case of defective returns. Earlier, ITR will be treated defective if all due taxes are not paid prior to filing of ITR. From assessment year 2018-19, ITR will not be defective even if taxes are not paid. There is a very important change in section 145A with effect from assessment year 2018-19. This is relevant for computing profits and gains of business or profession. Now, turnover will be considered inclusive of taxes like GST, service tax or VAT. This will have an impact on turnover for the purpose of section 44AD or Section 44 ADA. Turnover will increase as a result of including taxes like GST. Also, for determining whether tax audit has to be conducted under Section 44 AB, taxes like GST will have to be included. Once the tax return filing is complete, we get a 143.1 intimation. It is important to note that 143.1 is only an intimation and it's not an assessment. Hence, a return can be revised even after getting 143.1 intimation. From assessment year 2018-19, 143.1 intimation will not contain mismatches with Form 26AS. The assessing officer may conduct a scrutiny assessment after issuing a notice to the assessee. The notice for scrutiny assessment has to be served on the assessee before 6 months from the end of the relevant assessment year. In case the notice is received after this time limit, the assessee may intimate this fact to the AO by way of letter. He can also mention that he may raise an objection during appellate procedures. If this is not done, the assessee will not be able to object this at a later point of time. In the course of a scrutiny assessment, if the assessee comes to know that he has forgotten to avail or claim a deduction, he may make a request to the assessing officer to consider the same in his assessment order. Similarly, it may happen that the assessee has made a claim in his income tax return. For example, in the case of a cooperative society, deduction under Section 80P is claimed based on the Kerala High Court decision. But the assessing officer is not willing to allow the same. In such a case, the assessee may make an application to the Joint Commissioner under Section 144A. The order of the Joint Commissioner will be binding on the assessing officer. In case the assessing officer has reason to believe that income has escaped assessment, he can go for reassessment. In such a case, AO, the assessing officer, is bound to give the reasons recorded in writing to the assessee if a request is made by the assessee. The reasons recorded may come in handy at the time of further proceedings. I hope that the above discussed points will be useful for you in this return filing season. Let me conclude this presentation. Thanks for your patient listening.